basic story there for Solar is effectively the largest U.S. module manufacturer, but they're tiny relative to some of the large volume suppliers in China, Jinko Solar, for example. First Solar has less than 3% market share globally, but they are punching way above their weight in terms of profit generation. So they've got small market share, but they are the most profitable player. We think they've got some continued upside to consensus.
This sizable C plant is expected to cost roughly 38 billion pounds in 2024 prices, which means roughly translates to 14 billion per gigawatt, or 14 million per megawatt, which makes it the most expensive reactor ever built.
So it's very likely that we're in an oversupplied market, which means, I think, continued pressure on oil prices. So I think oil prices will be anchored in the 60s at the moment. I mean, they've been anchored in the high 60s. I would argue that it's more likely that they are anchored more in the mid 60s towards the end of the year.
I think for land drilling, things are certainly trending lower, particularly in North America. And, we've seen decreases in the rig count with cuts on the oil side offsetting increases on the gas side for the last 3 weeks. And so we've seen a lowering of expectations in general for U.S. land drilling in the second half of this year.
I think the more interesting bit from Aramco earnings has been that their free cash flow generation, their organic cash flow generation, has not been able to cover their dividend payments for a while now. So in the second quarter, their free cash flow was around $15 billion, and their total dividend payment for the quarter was around $21 billion, which means they need to keep borrowing or use up their cash reserves to keep paying these dividends, which are obviously very important for the kingdom.
Very much apologize, folks. We've had technical difficulties today. Zoom has been completely redesigned for us, at least once again. The screen layout's completely different, so a little bit of a technical snafu, but I do believe we are all here now. So sorry for the difficulties. I'm just going to quickly run down on the call today. We have some of the regular crew from Bloomberg Intelligence. We've got Sally Omez joining from Zurich today, swinging over to Madrid. We've got Patricio Alvarez. And then joining from our New York City headquarters, we have Scott Levine joining us. So that is the crew for today. And Sally, I know you already gave a rundown of where the oil market's at, but I'm going to have you do it again because I think I was the only person that could hear it. So Brent crude, $69 roughly here at the moment. But give us your take on the market. Why are we here at 69 today, and what's your outlook for 2H?
Sure, happy to do it again. I'll try to be as brief as possible, but I was just saying that there's a lot going on in the wider markets and in the oil markets, but prices have generally been stabilized around $70 a barrel, just below $70 a barrel. I think the rally that we've seen earlier today is mainly driven by the news, the headlines that we're seeing around potential secondary sanctions on the buyers of Russian crude by the Trump administration. I think that's especially targeting India, which is a big buyer of Russian crude. That being said, I mean, I understand why the market would rally on that, but whenever we're talking about potential disruption to Russian flows, I would just look at the history of the last couple of years and how resilient those Russian flows have been. So I'm a little bit doubtful on how bullish that actually is. Perhaps more importantly was the OPEC Plus meeting from last weekend, and I did spend a couple of minutes talking about that following your question. But very briefly, I mean, they did approve another output hike for September, a meaningful one that's going to be another almost 550,000 barrels per day of an output hike in September. And that will complete this current tranche of 2.2 million barrels per day of output cuts. Looking beyond September, though, I mean, our market balance shows potentially a significant surplus towards the fourth quarter. So we think it's very likely that next time OPEC meets, they decide to pause all output hikes between now and the rest of the weekend. But even if they do, our general outlook for the rest of this year is that the price risk is still very much tilted to the downside, because we are looking at some of these barrels that OPEC Plus has decided to bring back to the market. They will actually hit the market later in the year. And then when you look beyond just OPEC Plus, a lot of the non-OPEC Plus production continues to grow, and compare that to the demand outlook, which is not necessarily very rosy between now and the rest of the year. So it's very likely that we're in an oversupplied market, which means, I think, continued pressure on oil prices. So I think oil prices will be anchored in the 60s at the moment. I mean, they've been anchored in the high 60s. I would argue that it's more likely that they are anchored more in the mid 60s towards the end of the year.
Fantastic. Thank you, Sully. Scott, I want to get your reaction to that. You cover a number of the drilling names, oil service names. What's their outlook for 2H looking like? And what have you been hearing as you've been engaging with some of the management teams?
Yeah, I think for land drilling, things are certainly trending lower, particularly in North America. And we've seen decreases in the rig count, with cuts on the oil side offsetting increases on the gas side for the last 3 weeks. And so we've seen a lowering of expectations in general for U.S. land drilling in the second half of this year. International, I think the expectation is a kind of flattish. We've seen the much more severe cuts in the first half of this year overseas, but it seems like the expectations there are stabilizing, with a lot of focus really on Saudi, as Sally mentioned, and also Mexico, which has come out with some announcements regarding their plans or hopes, in any case, to stabilize spending and stabilize Pemex specifically. And then turning the offshore side, we just got off the Noble call for earnings 2Q, and the expectation there, we saw Transocean yesterday. We saw a good response actually in both stocks to the numbers. Despite Noble missing slightly here, they raised the EBITDA guidance slightly for the full year, and their expectation is really that we're going to see a slow next 4 quarters, give or take, but that we should see improvement in activity levels in the second half of 26, perhaps, or 2027. Where we've seen the greatest slowdown has really kind of been West Africa, and to a lesser extent, the U.S. Gulf, and areas of strength, Brazil still, and other pockets within Latin America, Guyana, Suriname, etc., still seem to be holding up relatively well. Northern Europe also weakening a bit. So fundamentally, it seems like for offshore, outlook is still deteriorating. We're still kind of in a holding pattern for at least the next year or so. But that visibility around improvement is perhaps strengthening for a recovery toward the back half of next year, perhaps the earliest.
Okay, thanks. Patricio, before we come to you, I just want to swing back to Solly and keep it oil focus here for a second. Aramco reported just the other day here. They're one of your tier one names that you cover for BI. Give us a sense of kind of what's going on with them, and how does it jive with what we just heard Scott discussing?
Yeah, I mean, just following up on what Scott was saying, the 2Q results weren't great. I mean, we didn't expect them to be great. It was a slight miss on net income. And this is something we talked about on this call before. I think the more interesting bit from Aramco earnings has been that their free cash flow generation, their organic cash flow generation, has not been able to cover their dividend payments for a while now. So in the second quarter, their free cash flow was around $15 billion, and their total dividend payment for the quarter was around $21 billion, which means they they need to keep borrowing or use up their cash reserves to keep paying these dividends, which are obviously very important for the kingdom. That being said, I mean, Aramco still has a very strong balance sheet that they had repaired during the 2022, the extraordinary year of profits, both in upstream and downstream, which had allowed these companies to repair their balance sheets. So their gearing ratio is around 6.5% at the moment, which is one of the lowest in its global peer group. But perhaps the trend is a little bit more important and more interesting. And it will probably continue to drift towards 10% pretty soon. That dividend is, again, very important for the Saudi government. So I don't think they will be cutting that anytime soon. And their capex guidance remains in the range of $52 to $58 billion. That's, of course, a lever that they can play around with. They can lower if they need to. But they have been talking about how these marginal growth projects in both oil and natural gas are very important for the company. So I don't think they will be lowering their capex guidance anytime soon either, which just means that it's very likely that we continue to see their gearing ratio just edge higher in the next few quarters. And I think that's the item to watch.
Do you expect any response from the government of Saudi Arabia to get their fiscal break even a little bit closer to where they're operating at now? Or, maybe that's outside the realm of how the management team wants to discuss things, but I'm curious to get your read.
I think that's beyond just Saudi Aramco. I think that's more for the government to decide. But you're right. I mean, the total spending level for the government is important for that fiscal break-even number. And I think it wouldn't be surprising at all if the government decides to at least downsize some of these kind of economic transformation projects, which we've started seeing some examples of. Maybe not outright canceling some of these projects, but just downsizing them or changing the plan on some of them is almost certain, I think.
Okay, very good. For anyone who's monitoring the conversation here, if you want to drop a question for any one of us into the chat, we'll try to work it into the conversation. But Patricio, let's come over to you. I got a couple things in my mind, but let's keep it molecule focused first. So we heard Solly and Scott wax philosophically about their view on the oil market. What's the translation over to the gas side of the equation? Where are we at in terms of European gas market for 2H? How's it feed into the LNG story as well?
Sure. So yeah, we're still stuck at around 35 euros per megawatt hour, which is very similar to what we were where we were at in June, and we expect it to remain range bound going into the second half. And that's despite the fact that we will enter the sort of the heating season in November, and that's because we've made very good progress here in Europe in closing the storage shortfall. So at the beginning of the reinjection season, which began on April 1st, the gap versus the same time last year was roughly 25%. So our storage was 25% less full than in 2024. Right now we're hovering around 70% full, which means we've bridged the gap to roughly 14%. So that's quite an achievement, and that's mainly because demand for LNG in Asia has faltered. It went down by double digits, by almost 22% in the first half of this year. And while in July we've seen a very small recovery, so Asian LNG demand rose roughly 1% year over year in July. That doesn't seem like it's going to be enough to reverse this trend of sort of overall weakness in Asian LNG demand. That's mainly because China has been seeing rising domestic production. They also have quite a significant coal-fired fleet, and they're also advancing quite fast on renewables. So that's what makes us think that prices will perhaps remain range bound 35 euros per megawatt hour into the second half, and perhaps weaken even further into 2026, and that's mainly because we expect to see some new liquefaction trains, especially LNG Canada and some liquefaction trains in the U.S. start up operations in the fourth quarter of this year, which barring a recovery in Asia, that should widen or loosen the LNG market. Just as a reminder, Europe only has roughly 40% of its LNG under long-term contracts. So that means that we need to compete on price for those spare cargoes, mostly with Asian markets. And I think it also ties down with what Sally was mentioning on this sort of this easing or downside risks to general molecular oil fossil fuel demand in the next 12 months. I think LNG is part of that story, and that should make it a bit easier for Europe to weather next winter.
All right. Thank you very much for that, Patricio. Let's switch to electrons instead of molecules. Just the other day, I think it was yesterday, Secretary of Energy Chris Wright posted on X that nuclear is the single biggest issue he works on. And so nuclear seems to be getting a lot of focus from the Trump administration over here in the States, Patricio. But I'm curious, what's your take on where nuclear is at in Europe? I know the UK has got some really high-profile projects coming down the pipeline that are coming in quite expensive. But give us your read on nuclear in Europe, and Scott, I also want to get your thoughts on the US afterwards. But Patricio, to you first.
Sure. So I think I would start by saying that the key difference I would say from the U.S. and Europe is that Europe doesn't have a federal state that can support widespread policy across the region, across the continent. But you pointed out the UK. The UK, I think it's making inroads into that ambition of almost quadrupling their nuclear capacity by 2050. The fleet right now is roughly 6 gigawatts. 90% of it is 80 to 90% of it are reactors that came in online in the 70s and are due to be retired by the end of this decade. That said, the government, or the new, let's say, there's a new plant being constructed called Sizewell C, or that's going to begin construction in 2028, and that was a landmark moment for the sector, I would say, and that's because this plant will come under a regulated asset-based model. And what that does, it means that utilities don't face the funding risk if the plant suffers delays or cost overruns, like you mentioned. This Sizewell C plant is expected to cost roughly 38 billion pounds in 2024 prices, which means roughly translates to 14 billion per gigawatt, or 14 million per megawatt, which makes it the most expensive reactor ever built. That said, this RAB model will mean that utilities would not have to front the costs if the plant ends up not being built, or if it, from all the cost overruns or budget overruns. We are running the numbers in terms of how feasible that 2050 target for 24 gigawatts is. Just for context, we're at 6 right now. If we get Hinkley Point C, which is already under construction, we get that built plus Sizewell C, that will pretty much double the current fleet. And if we build another 3 gigawatts, which will be probably the same design as these other two, that roughly gets us to roughly 15 gigawatts. And by then, if we're talking about the 2035s, more or less, then we expect the Rolls-Royce a small modular reactor to come in line. And for that, although if you compare it to the US, where I think there's already one model that is already approved by the regulator, in the UK, we're still not there. We expect the final regulatory approvals for constructions for the Rolls-Royce SMR to be ready by 2030. So things are still in the balance, but it does look like if we get to that commercial operations for the SMRs in the mid-2030s, there is no reason to believe that we cannot approach that 24 gigawatt mark by 2050.
All right, thank you, Patricio. Scott, I want to get you to weigh in on nuclear, and I'm going to give you a couple plugs here. First, just the other day, I know you got a note out with Gabriella from our utilities team. The headline on that note: Big tech may help fund 350 billion in new nuclear to power AI. And just quickly, I'll note, BI has so many analysts. We cover all the sectors. Mandeep Singh from our technology team put out a very interesting note about hyperscaler capex. And I think one of the big takeaways I took from that note is at the start of this year, consensus capex for the hyperscalers was 329 billion for how much they were going to spend next year. And from the start of the year through early August, expectations have increased 46%. So now the hyperscalers are expected to spend 478 billion next year. So we've seen capex budgets balloon. They are chasing the prize of AI, and all the hyperscalers, they're all talking about nuclear as part of that conversation. So Scott, read the tea leaves. Are the hyperscalers really going to build a lot of nuclear here in the U.S.?
Yes, we believe so. However, it's going to take a long time. We're still in the early innings, and a lot needs to be sorted out. And so, just to kind of put some frame around the 350 billion, basically what we are assuming there is our base case, if you will, scenario is that we see a 60% increase in capacity versus call it 100 gigawatts, give or take today, by 2050. And so our assumption there is that we break ground in 2028 and that it initially takes us 10 years to build a nuke at $10,000 a kW. And then ultimately through efficiencies, we get to 5 years per nuke at $5,000 per kW over time. And if you aggregate all of those costs, you come up with $350 billion to build 60 gigawatts or a little bit more than 60 gigawatts of capacity. Getting to the hyperscalers and how we're going to pay for all of this, right? So there's three main buckets, right? There's the hyperscalers, there's the utilities, and there's the federal government, and coming through with subsidies, et cetera. And I guess the punchline is really that given how badly the last build went with Southern Company, which is really the only nuke that's been built in the last 50 years here, it effectively cost over 30 billion, and it took twice as long to build as was expected. The hyperscalers are going to have to pick up a large chunk of the tab here. Utilities are probably going to be reticent to put their money at stake and the reputation at stake, given what transpired with the last wave of builds. And also what remains to be seen is what the federal government comes up with. And they have intimated, in addition to Trump signaling support for nuclear, willingness to tap a $67 billion green fund in order to help pay for these. We have yet to see the details there, but I think the hyperscalers are going to have to account for a large chunk of the funding to support this. And as yet, we've seen some agreements with hyperscalers and to restart some of the nukes, the full-size nukes that are already in operation, but that were shut down recently. We've also seen some announcements of collaborations and interest in some of the SMR technology. Only one, as Patricio indicated, has been approved by the U.S. government, and that's NuScale's small modular. But so a lot remains to be figured out here yet. But the fact that the nukes are, the fact that the hyperscalers have signaled positive intentions there suggests they will come forward with a fair amount of the funding for this, and will probably need to for this to happen.
Thank you, Scott. I'm curious, you cover Liberty Energy, so I think you know the secretary, or at least familiar with him. What do you make of, ostensibly an former oil and gas CEO, and he's really pivoted, and he does seem to be focused a lot on nuclear. Is that surprising to you, sort of generally, as you read the zeitgeist, or is nuclear just the time has arrived?
No, I think it makes sense. I think, you know, he's certainly been a showy guy. You know, he's been very much, you know, a vocal CEO for years. Regarding and to be clear, Liberty is a pressure pumping company, right? And so he's just been very pro oil and gas. He hasn't been anti renewables or nuclear per se. His point has really been that we need to be realistic about everything. And so you know, I think with nuclear, it's not just the fact that he's on Trump's team right now, and is, you know, speaking the Trump playbook per se, but I think there's a recognition that in order to support AI demand and computing needs for the long term, that nuclear needs to be part of the equation. And hey, it's going to take a long time and a lot of money to do this, so we really need to get serious about it. So I do think it is serious. I do think it is not inconsistent with what he's said historically, and you know, suggest that this will happen. What we've tried to say is, you know, be realistic in terms of the expectations, given, you know, the fact pattern over the last several decades, frankly.
All right, fantastic. Quick bit of admin here. You know, we hold these calls every Wednesday, and on next week, we're going to have Herbert Crowther from Eurasia Group join us. So geopolitical research org. We'll get some pretty interesting insights from that conversation. So make sure to join us for that next week. Got a nice external speaker, and then from me, I just want to let everyone know, if you haven't seen it on the wire, we have reiterated our focus idea on First Solar, and we also, which follows on the heel of us reiterating on In-Phase a couple of weeks ago. And the basic story there for Solar is effectively the largest U.S. module manufacturer, but they're tiny relative to some of the large volume suppliers in China, Jinko Solar, for example. First Solar has less than 3% market share globally, but they are punching way above their weight in terms of profit generation. So they've got small market share, but they are the most profitable player. We think they've got some continued upside to consensus. So make sure to check out our note to understand why. They've really weathered all the policy changes pretty well, and I think they've got a pretty favorable outcome from the tax changes. So go make sure to check out our note and get a sense of why we're pretty positive on the fundamentals for that company. And so let's round out the discussion with a similar readout. You know, I think we've had good sets of numbers coming from a number of the solar names, but Solly, 2Q, we already talked to Aramco, but more broadly, how did 2Q shape up? I know we're not fully through the earnings cycle yet, but I want to get your readout on just kind of generally how your names have done. Have we met expectations? Are we exceeding expectations? And, you know, what do you make of what you've been hearing?
Sure. So perhaps I'll start with ADNOC Gas, which reported this morning. And I think this is a pretty interesting story because ADNOC is not listed as the group like Saudi Aramco. What they've done is that they listed some of their subsidiaries, and ADNOC Gas is the natural gas arm. And they had a beat this morning. They increased their guidance on sales volumes. And what they're showing is a pretty strong domestic demand growth still, and still improved margins. And I think what's interesting about this company is that it's a very unique company. It's part of ADNOC. It distributes gas, but it is expanding quite a lot too. So it has the futures of a utilities company a little bit, with a lot of the kind of stable margins with some upside. But at the same time, they are expanding their natural gas production and LNG capacity. So I thought that was really interesting from today. When we look at some of the mid-sized integrateds, which is also part of my coverage, generally pretty in line. I mean, we knew realized oil and gas pricing for these companies would be lower, and I think that was pretty much baked in to consensus. both Gulp and Repsol actually beat consensus estimates in the second quarter. What was interesting about Repsol was that their upstream was pretty strong. Despite lower prices, but also their downstream. We talked about the Iberian blackouts on this call a few weeks ago, and we flagged that that was going to be a headwind for the company, and it was, but still they showed some resilience through that. And for Gulp, which we also have a focus idea on, we've been flagging that their upstream is pretty strong, and Namibia is still a very important long-term growth catalyst. So they've beat estimates, and they are increasing their guidance for their EBITDA for 2025, as well as their upstream output guidance for 2025. So generally no massive surprises. I mean, a lot of the indicators were, trending in the way that we and the rest of the street expected, but still some nice and small beats by both Repsol and Gulp in the second quarter.
All right, thank you, Saleh. Just a quick advertisement. Since you are in Zurich, I know we do have some regulars on the call who are based in Zurich. So shoot Saleh an IB. Make sure he buys you a coffee or something. Get together and say hello to him in person, since he happens to be there. It looks like you're there tomorrow as well. So not just today, but also tomorrow. Okay. Patricio, let's swing around to you. We kind of heard your gas and nuclear perspective, but obviously you've got a big cohort of companies that have been reporting out as well. So give us your read. How's 2Q been shaping up for the European gas and power landscape?
Sure, I think I can briefly summarize it, just touching upon the three large, diversified, integrated companies we cover. So we're talking about Enel, Iberdrola, and Engie. And I think there's not a lot of surprises there. 2Q tends to be a seasonally weak quarter for utilities, given that it's sort of a shoulder season for energy demand before we enter the cooling season in the summer. But that said, things to note is that we did see weaker than expected energy trading profits, so that's commodity trading, and also very weak results in gas-fired power margins. And that's because in 2Q, the spread arbitrage potential for European gas was not very high, and although these companies trade much more than just European gas, we sort of use it as a bellwether to track what the performance can be. So worse than expected results in sort of the cyclically exposed parts of the business. We saw robust gains in networks, because these companies have been in the process of increasing their capex into regulated networks since early 2024, and they're seeing the fruit of that. I think the other part that quite surprised us was that retail margins have weakened significantly this year, which sort of raises a signal of concern into 2H, mainly because we've seen stagnant demand. So energy demand in Europe has been very, very weak. Aside from the weather-driven upside in the first quarter, it continues to be very, very weak. And since prices are still relatively stable, that means that competition in retail is getting more intense, and some of our companies are losing that market share. And just as the next catalyst to watch in our space, we don't expect any significant downgrades to guidance. We just don't expect upside from where we are. And I would say the next big catalyst for our group will be a final decision over regulated returns in Spain. Most of the companies we cover have some exposure to networks in Spain, and Spain remains sort of underinvested in terms of network capex relative to other countries, and changes in the next draft regulation into 2026 to 31 could be critical for companies like Enel, Endesa, and Iberdrola, and could potentially shape their capital allocation into 2026 and 29.
All right, thank you, Scott. Let's come back to you. I know you covered some of your earnings already, but maybe a little bit broader brush if you want to zoom out and give us the sort of big takeaways on 2Q from your portfolio companies.
Yeah, I mean, I guess like the one thing I would say, the I'd say the outlook for this year, it didn't get materially worse this quarter than it did, as opposed to last quarter when it did. It was probably revised down a little bit, but most of the stock responses have generally been pretty good, including today. Noble's up over 5, Transocean's up over 7. And so it generally seems like with oil drifting up the price, that, this or worse was anticipated by the stocks. And so, we're moving up from here despite the fact that the outlook fundamentally is maybe a little bit darker for the second half of the year. And the other thing I wanted to mention too is that it does seem like the M&A pace has picked up a little bit within the services group. We saw Baker Hughes announce an acquisition, Chart Industries, kind of scuttling a deal that Chart and Flowserve had. It's more kind of on the industrial equipment side. Schlumberger closed their Champion X acquisition after a very lengthy justice review, and just yesterday we saw Shelf Drilling agree to be acquired by ADES, which is a Saudi jackup driller, contract driller. And so it does seem like the deal-making pace has picked up a little bit. General sentiment has improved a little bit, despite the fact that the outlook is still fairly bleak for the second half of this year. And so we'll see what happens with the macro and the commodity side of things going forward. But a pretty encouraging earnings season overall, I think, for the services sector anyway, and a more active deal pace. So also an somewhat encouraging sign for growth.
All right. Well, we will leave it there for today. So again, thank you all for joining. Sorry for the little bit of technical snafu of us getting started. Hopefully it'll be smoother on the next round. And again, join us next week. We will have Herbert Crowther on from Eurasia Group. Look forward to speaking with him. We're all green dots on the terminal right now. So shoot us an IB or an email if you have any follow-up on any of the topics we discussed here today, and look forward to being in touch. Great. Hope you have a great rest of your week, everyone. Cheers.